Loeffler here with InTune Business Advisors, where we transform your manufacturing business into financial freedom through superior business valuation, growth, and exit planning strategies. What do I want to talk about today? Well, in this installment of our Knowing Your Numbers series, I'm going to talk a little bit about a company you might have heard of in the past, Vandelay Industries. Now, they're a big importer-exporter out of New York. Latex and latex-related products. They were really big, made a splash back in the 90s. A couple of high-profile salespeople that went through there. You might have heard of them. But in any event, what they've done in recent years is they've actually vertically integrated, and now they've got a big manufacturing plant in upstate New York here in the States. And I thought what I'd do today is walk you through a break-even analysis and show you what the fundamentals of that analysis look like, as well as how you can use it to improve your business and really use it to plan and really kind of kick the tires around some of your planning assumptions and see where you may be able to cut some costs or make some improvements. All right, let's go. Okay. Well, let's take a look at Vandelay's break-even point in units for 2025. And typically when you do a break-even analysis, you're going to want to take a period that represents your operating cycle, which is typically a year. Most people are going to budget in terms of a year. And you want to do this from a go-forward perspective. You can do a historical break-even analysis, and maybe that's helpful just to inform you. But when you do it on a prospective basis, budgeting, it's just a lot more informative. So here, what we're looking at is Vandelay's 2025 budget, and we've got they're looking at sales of $25 million, and that is over 25,000 units sold for an average sales price of $1,000. Now, these units are 55-gallon drums of latex, and they estimate it's going to take them about $18 million, just a little over $18 million in variable costs to produce those 25,000 units, or a unit cost per 55,000 per 55-gallon drum of 721. So simply subtracting 721 from 1,000 gives you a unit contribution margin of $279. Now, what is a unit contribution margin? What does that mean? Well, given the fact that their fixed costs in their budget is $4,333,000 and some change, this $279 for every unit that they sell contributes $279 toward covering those fixed costs. Okay, so if you're just covering your fixed costs for the year, then you're going to break even. Okay, and just doing the simple math here, dividing these fixed costs of $4.3 million by 279 gives us a break-even unit volume of 15,532. Now, I don't know how seasonal latex is and whether or not it's a huge seller in the fourth quarter or if they have a really quiet quarter in the second quarter. Well, I'm just assuming that it's pretty even throughout the year. So if we divide this break-even units by 12, then we're saying that Vandelay has to sell at least 1,294 units to break even every month. Okay? Now, a couple of other things we can do with this, but I do want to delve into the variable costs here in a minute. The other thing is when you look at this level, you can right away start identifying, okay, well, how do we lower our monthly break-even point? And you've got a couple of levers here. Obviously, increasing the sales price is one. Who wouldn't want to increase the sales price? But of course, we know that customers are not always going to accept those higher prices. Another probably more realistic lever is going to be looking at your variable costs, and in particular your production costs, and looking at how do we shave some of our variable production costs out of this equation. And that's where obviously you turn to your operational improvements, etc. The other is, how do we lower our fixed costs? What's our cost structure look like? And over a period of a year, these fixed costs are by definition fixed, meaning there's not a whole lot you can do. But if you approach budgeting in a way that says maybe we can get a better deal on our healthcare benefits or other longer term commitments, or at least those commitments that you're gonna engage in for the next year, maybe you can lower your fixed costs. So those are the three levers you can really use to start lowering your break-even point. Okay, so that's one concept I wanted to just share with you. The other is we can start taking a look at, well, what does this mean for our profitability? And if we're planning on selling 25,000 units of latex in 2025, and our break-even volume is going to be 15,532, that leaves, as soon as we hit that point, every single unit above that, in other words, 9,468 units, will contribute $279 to our profit. And right now, I'm just looking at this, keeping taxes out of it, keeping that noise out of it, that would be our operating income. And again, just straight lining that over 12 months says we should be averaging $220,000 in profit given this budget. So let's delve a little bit deeper into, well, how are we coming up with a unit contribution margin? And what I'm looking at here in this tab is Vandelay's budget, and we're looking at these in dollars and thousands, so this is still $25 million, okay? But what I'm doing is breaking down their COGS and their SG&A, and you may have additional departments, but basically I'm taking all of their costs and I'm identifying them and classifying them as either variable or fixed. And this is an oversimplified example. You could really delve into a lot of different line items and say, well, some of these are semi-variable. They don't vary directly with sales, but we have control over them. We can determine how much we want to spend. I mean, marketing or sales could be one. So this 625,000 might go up or down. You have some other ones in here as well, travel and entertainment, your material, your labor up here. Again, this is where you would focus to drive efficiencies, the biggest bang for your buck, are up in here in COGS. But also notice that Vandelay put some benefits and some other costs up there as well. And I've just designated the benefits and other costs as fixed. So that's why you don't want to just simply say, well, it's our sales minus our COGS is our gross profit, and that is our unit contribution margin. That's our contribution margin. No, you really want to go down one more level and really pretty much set aside the notion or concept of gross profit and really take a look at your variable and fixed costs in this fashion. Okay, and so your total fixed costs, again, is $4,333,000. Your total variable costs from here are just over $18 million. You can see here as well that your operating income is, again, consistent with our break-even analysis, $2,642,000 right down here. Okay? And again, $2,642,000 over here. And so the break-even analysis, when you get right down to it, it is a really powerful tool to really guide you in terms of budgeting and saying, okay, are we looking at this? Is our budget realistic? What did we do last year in unit sales? What was our contribution margin? How do we improve our unit contribution margin and or reduce our fixed costs to lower our break even? Because remember, the lower your break even point is in units, given your sales capacity and your production capacity, the more profit you're going to have. So I really hope that helps, and I'll see you on the next one. If you're planning on growing your business through acquisition, or if you're planning on selling your business in the near future or even in the next decade, click the link below and schedule a free call with me. I'm happy to answer any questions you have. Remember, you know your business better than I ever will. Let's make sure we get a great price for it so you can enjoy the financial freedom you deserve. I'm Jim Loeffler. Get the insight, get the value, get in tune.